The latest deal in the consolidating shale sector shows why some companies can pay more than others. Diamondback Energy has agreed to pay $26 billion for Endeavor Energy Resources, and the deal creates the third biggest producer in the Permian Basin. That's the land in Texas and New Mexico, which has been the center of the American oil boom over the past decade. Given the demand for resources here, and how oil M&A has been generally, any company selling is going to attract a lot of attention. After all, Exxon, Occidental, and Chevron have all agreed to major deals within the past year, and Endeavor was one of the last biggest private firms remaining in the Permian. All this means lots of demand for Endeavor, and it pushed up the final cost. The price was about $1 billion more than it probably should be based on how much oil and gas both firms produced in the fourth quarter, and Diamondback's total market value prior to the merger. And the price looks even more inflated based on core locations each firm has. Now that's fine, but the two companies are neighbors. Both specialize in the Permian, and their land wraps around each other. Combine them, and the acreage can be developed more efficiently. Their headquarters are even a block away from each other. This all means lots of savings from combining the two firms, about $550 million a year worth, according to the buyer. Now these savings mean that Diamondback could afford to pay more than rivals, and at the agreed price still have something left over for its investors, even after paying a premium. Indeed, Diamondback shares were 9% in the news, adding $2.5 billion to its market capitalization. Given that deals often cause the buyer's stock to fall, proximity matters in oil M&A.